Cool. Now I'm so excited. We have Eric. Hello, how are you doing, Eric?
Hi, Sandras. I'm pretty good. How are you?
Fantastic. I'm very well, very well. Looking
Yeah.
forward to your session. And yeah, so by way of introduction, Eric uh, is an investor from Chanzo Capital, and Chanzo Capital focuses on the kings, which is like Kenya, Ivory Coast, Nigeria, Ghana, and South Africa. And he's going to share some insights around what you need to do as an entrepreneur, but also please type your questions that you have for Eric in the chat box. So Eric, I'll leave it up to you, and you can share your screen, you can share your presentation.
All right. Thank you very much, Sandrine. And it's a pleasure to be on and to be part of this interesting meeting, Get Funded Summit. And I'm trying to share my screen. You got to allow me to share the screen from your
Okay.
side. All right. Okay. So thanks a lot, Sandras, for inviting me, and pleasure to meet you all. I'm just going to go to a few slides around, how to raise money for your startup. I'm sure that over the last 2 days, you've gotten quite incredible presentations from the other speakers. So whatever I'm going to present is to add to that. So I'll go for 20 minutes, and then I think I've blown 5 minutes already. So I'll go for 15 minutes, and then we'll reserve 10 minutes for questions. As Sandra said, I run Chanzo Capital together with three of my colleagues. We have an office in Accra, Nairobi, and Johannesburg. And we primarily have invested in the King's countries, which is Kenya, Ivory Coast, Nigeria, Ghana, and South Africa. So a lot of this is sort of a bit of from our experience of doing this since 2013. So a bit of introduction is sort of raising money. It's an art and not a science. Generally, building a company is a science, but raising money is a little bit of a different form, which is an art. In other words, the way you raise money is a little bit different from the science of building a company. And so as an entrepreneur, you have to be able to multitask. In other words, you should be able to engage in the science of sort of building a company, and then the act of being able to raise money to make the company work. And the act of raising money starts with relationship building. And relationships are important. Generally, as you may know from your life, your personal lives, you always are able to give money to somebody you have a relationship with. Once in a while, you may see a stranger and you're able to give them money. But rarely do you do that. Most of the time, if somebody walks up to you and it's somebody with a family friend you went to school with, from the neighborhood, it's easier for you to part with money. So the first rule is that you need to understand that relationship building is important. And relationship building takes time, right? And relationship basically leads to trust, right? So when you have a relationship with somebody, they trust you. And so if they trust you, then, they can do things for you. So, but to build that relationship, generally it takes time, right? So I always tell entrepreneurs that the best time to raise money, therefore, is when you don't need it, right? So you see how the chronology works. You have to build relationships that are the basis of trust. To build that trust and that relationship, you need time, right? And so, and the time really is when you don't need it. And so when you start building a company, you need to also start thinking about how do you build relation with people that may invest in what you're doing. And you will see that as you go along the line, how that relationship plays out in the early stages of raising money. The fifth thing is it's important for you to also outline the kind of investors that you need. In other words, when you're building a company, you have a value system that you engage. So it's important for you to also think about that in terms of who you're going to bring us as an investor. So in that regard, you don't need to take money because it's offered. a lot of the time, entrepreneurs tell me, oh, Eric, if I don't raise money, my company will fail. So anybody who offers me money, I should take it. But I have a lot of anecdotal experience of entrepreneurs that have raised money from the wrong investors or the wrong people, and their company also failed. So the same way that if you don't raise money, your business could fail, the same way if you raise money from the wrong people and on the wrong manner or using the wrong instruments, your company could also fail. In other words, it's not just enough to raise money. You have to do it properly, the same way that you build your company to succeed. And finally, don't raise more money than you need at any time. A lot of entrepreneurs come to me and they say, Eric, I just started this idea. This idea looks like Facebook, and Facebook is worth 50 billion. So my idea is like Facebook, so I'm worth 50 billion. So can you give me 100 million now? Right? If I give you 100 million now, then I own the entire company. Right? So the lesson there is that yes, you may be building something similar to Facebook, but you are not Facebook. When Facebook started, if you go and read Facebook's story, it was a company that started with zero. At a point, it was somebody's idea. And they raised a little bit of money, and then they built the product, and then they tested it, and then it was working. Then they raised a little bit more money, and then on and on and on. And today, they raise money in the billions. So it's important for you to understand that the money raising process also takes time, and you have to raise bits at any point in time to prove the business model. And that's why it's important for you to understand the various elements that you need to be able to get a business going. And that is the essence of the next slide, which is so what do investors look for in accessing the company? So traditionally, if you look to the right side of the screen, there are three main circles that generally investors pay attention to. The first is product. So most of the time, when you're an entrepreneur, you actually build a product to solve a problem. But in today's world, there's so many products solving the same problem. So the question becomes, in an investor's mind, how unique is your product? So you need to think about uniqueness as an entrepreneur when you're building your product. The second is the market to monetize. And here again, the important thing to understand is that it's not enough to say there's a market for my product, but you need to be able to show that you can monetize that market. I.e., if you're an entrepreneur in Lusaka, I expect you to be able to tell me as an investor that Lusaka has a population of, let's say, 5 million people, and I live in a neighborhood that has 500,000 people, and I'm going to first sell to those people. I can capture 10% of that market and hopefully 20% of Lusaka, and then the whole of Zambia, and then the whole of SADC, and then certain percentage on and on and on. The problem is that a lot of entrepreneurs start by saying, oh, I'm building a product that looks like Google, and it's going to be a global game changer. And there are 3 billion people in the world, so my target is 3 billion. Yes, by all means, you're going to reach a 3 billion people or 5 billion people as the population grows. But you need to be able to show where you start from and build up into that 3 billion. And it's important that that is clear in your materials or when you're talking to investors. The third thing that investors look for is the team. And most of the time, team becomes sort of the pivot on which the other two rest, because it's the team that creates the product and it's the team that goes out to monetize the market. So as an entrepreneur, you need to be able to show the investor that either if you are a sole founder or you're a co-founder or you have an initial team, that team is a quality team that can execute. So in other words, it's not enough to say, oh, I have a team, my friend from high school is part of the team. Meanwhile, you're trying to build a software product and your friend from high school is an architect. Yes, great. He's got great background. He's an architect. But how does he help you achieve, the product you're trying to build? Okay, he may be an architect, but maybe he has a software background. He may be an architect, but he is able to sell. So he's the one that goes out to sell the product. He may be an architect, but he's the one that has a software experience as well, so he can write the software. So you need to be able to show the quality of the execution team and what role they play. Now, these three are generally the core, and team is really what sort of most investors sort of at an early stage, because at an early stage, you really don't have anything to show, right? So an investor is looking at whether you can execute. And so in Chanzo Capital, we have something that we internally we call execution risk. Is that at an early stage, you are taking an execution risk, and so you are looking at how that risk is minimized by the team. And so it's important for you to be able to show that either you as a sole founder can start it, or you have a co-founder, or you're going to look for a co-founder, or you're going to build a team to work with. And that's very important. Now, in the middle of team, I also put time and tenacity. Recently, timing has become a critical element in decision-making for investors, because it's not only enough to have a unique product, but the timing is critical. Because a lot of the gig economy businesses that you see, Uber, Facebook, Lyft, etc., these businesses were not new ideas. If you take Africa, new companies like Flutterwave, Paystack, etc., all in payment. But payments has been done by banks, But they have come with a different, unique product, but they got the timing right. Their timing, the rightness of their timing is in the digital economy that is creating across Africa. And so they are leveraging that timing that people want to go online. People want to be able to purchase online. And then the final thing is tenacity, being able to have staying power. Entrepreneurship is hard. It's not for everyone. So if you cannot, if you're not made for it, don't do it. But, in Africa, being an entrepreneur is harder. So it's important for you to have the ability to persevere. And that is a very important skill that will make you succeed in Africa. Because if you don't give up, over time, your timing will come into play. So sometimes you may not be the right timing, but if you stick around long enough, the timing will work out. So tenacity is really one of the things that we look at in Chanzo Capital as a way to determine how we back a company. Then to your left is sort of the three things that we provide, right? So we generally provide capital. We also provide capacity and community. This is what we call our Chanzo execution strategy, which is that we don't only write you a check, but myself and my partners, we are all guys who have built companies before in Africa. So we have quite a breadth of capacity and a breadth of community networks across Africa. And we also have offices on the ground. And so when we invest, we bring these elements to play. And so other investors also do it differently, but that's sort of our execution strategy. So now you ask me, so what are the various types of investors, that I need to look out for? Now, this, outline I have here basically also follows the path that you take in terms of the various stages that you need to raise money when you're building a company. So the first money you need to raise is from angel investors. And that is mostly what we call seed capital. Sometimes some people call it pre-seed or post-seed. There could be 2 or 3 rounds. But generally, when you have an idea, the first capital that you need is angel investment. And generally, the idea of angels is people who take early stage risk, without even knowing what you're trying to do, but just listening to what you have and the idea. And they are called angels because, they come from, they take an extreme risk, and generally they fall in 3 categories. They are families, friends, and the last category is fools. Now, if you look at these 3, the first 2, family and friends, you see that there's a relationship there, right? So the first people that most likely will invest in your business is your family and your friends. Why? Because they have a relationship with you. So remember my first slide about relationships, trust, and timing. So at an early stage, when you want to raise angel money, you most likely go to these people. Why? Because you have a relation with them, because they know you. So if you go to them and say, hey, I finally want to start a company, your family members know you. They know that, okay, John is a hardworking guy. He's been in corporate, or he finished school. He wants to start something. That is why your uncle most likely will give you some money. Your dad may be your sister, who maybe works in the bank and has some money saved up, So family will most likely be the first people to back, or your friends that you went to school with, your neighborhood friends, your friends that you went to school with. So they are the first people. And then the fools is a category given to people that you may not necessarily have a relation with. Remember, I told you that sometimes, you give money to people that you meet because you believe in what they're trying to do, but you may not have a relationship with. So rarely do you sort of get the fools. But yes, from time to time, you may get people that you don't have a strong, long relationship with, but you may meet them, and, you hit it off and they may take that risk. But they are very rare, but they're in that category as well. So you raise angel money to basically build the product, right? And in the tech world, we normally talk about a minimum viable product, which is sort of a product that somebody can, use, play around with, and then pay you for it, right? MVP, minimum viable product. And so it's important that you always have in your vision that when you raise angel capital, you at least want to be able to come up with a product based on that capital that you raise. Then you go to the next category, which is venture capital. And the name explains it, venture. It means that capital is now to help you increase your customers. Remember, when you build a product, you now have some customers. You have product market fit. So the next capital is now to acquire customers. And that is what you need venture capital for. And mostly venture capital firms, have it in their name. So you'll see it in their name, they're called a VC fund, the short for venture capital. And then, as your company grows, you have 10,000 customers, you have $1 million in revenue, and now you want to grow outside the country in which you are. You want to go into multiple countries, or you want to go into, new territories. Then you want growth capital, you're growing the business. So you go to, investors that give you growth capital. And then once you've grown the business and it's generating hundreds of millions of dollars in revenue, then you want private equity. Private equity guys normally buy control of the business. So when they come, they generally will like to buy a significant majority of the business, and they sometimes retire the founders, right? And their model is, okay, this business is generating $100 million. We want to make it generate billions of dollars, right? So they have a formula, and normally they want control, and they bring in new management, and they then take the company. And then, after it generates billions of dollars, then they take it, to the capital markets, right? I.e. the Johannesburg Stock Exchange, or the Nairobi Stock Exchange, or the Lagos Stock Exchange, or the New York Stock Exchange, or the London Stock Exchange, right? So that is the cycles that you go through normally. And those are the various investors that you meet along as you go through that cycle. So the next question is, so what instrument do these investors use in these funding rounds? So the first one, the angels, they normally use convertible notes. Now, convertible notes is a simple term to define a loan that can be converted into equity, right? So, because you have an idea and you haven't built anything, most of the time, your family members will say, oh yeah, I'm just supporting you, and they give you a little bit of money, and sometimes you don't even have an agreement, But basically what they're doing there is they're giving you a convertible note. So if your dad, your uncle, your sister, your friend gives you some money, and finally you build a product and it starts working, even if you don't have an agreement, it's important for you to go back and say, hey, this idea is working. I've got 1 or 2 customers. You give me some money. Now, can we agree on converting it so, I give you some equity, right? Most of the time, angels or people who do it formally will then give you an agreement. There's a convertible note that you sign, and the convertible has mostly 3, components to it. It's an amount that they give you. There's a discount on it, and then there is sort of an interest rate, on the money. Or sometimes people normally use the market rates that they have already. But the idea is that agreement doesn't value the business, because it's difficult to value a business when it's just an idea. Otherwise, it will be a tug of war where you say, my idea is like Facebook, so it's worth 50 billion. And then the investor says, well, you are not Facebook, so you can be 50 billion, right? Then there's a big, back and forth. So convertible notes have helped you to avoid that, And then, once you get a venture capital, then they want equity, right? At venture capital means you have customers. So now you can do projections. And if you do projections, you can do a discounted cash flow, and then you can come up with a value. So at that point, equity works. And then when you do get to growth, because the company is not generating a lot of capital, generally growth people use debt, because the company can service the debt, right? And that's where sometimes you can even get it from a bank, because a bank will say, okay, yeah, you're generating $50 million every month. So if I gave you a $20 million loan, you can service it, so sometimes it's there. Sometimes they also do a combination of debt and equity. And sometimes they do a mezzanine, and that's what they call mezzanine, right? And that mezzanine, equity and debt, follows on. So private equity guys use that as well in terms of their mix of capital that they provide. Then I put grants and I put an asterisk to it. Sometimes, at an early stage, you may not get family and friends, but you may be able to apply for a grant. If it's a research project, sometimes some ideas come from research projects, and research projects, you may get a grant. But what is important when you're getting a grant is please read the fine print of the agreement, because sometimes grant providers then sort of put ownership of the IP, intellectual property that you developed, becomes theirs. And a lot of entrepreneurs don't pay attention to that. And so they take the grant money, they build their company, and then, 5 years down the line, this grant provider comes and say, hey, the IP belongs to me. So now that you're selling the business, I own the IP. And you cannot, you do not own that IP. So, by all means, if you want to take grants, please pay attention to the final details of the agreement. So now that you said, give me some framework, I'm going to give you the final 2 slides, the do's and don'ts, just some things that you should pay attention to when you raise it. The first is preparation. Like everything else, you need to prepare to raise money. So in the earlier slide, the stuff that I talked about is part of preparation. But important to have your story. A lot of investors like stories. Why are you doing what you're doing? Most of the time, there is a lot of other things that you could do. You could get a job, you could work for someone, you could do other things. But why did you do this? Sometimes, you started this business because you experienced a problem. A family member experienced a problem, and then you thought you want to solve the problem. So that story is important, right? A lot of entrepreneurs miss out on that story, but that story is a way of connecting with investors. It tells a lot also about what you value, right? And investors want to connect with your value system, which drive the culture of the business. And then, you need to have documents. A lot of entrepreneurs have great ideas, they start the stuff, but they don't document. So try to keep as much document. If it's receipts, keep receipts, keep them, document them. Try to make sure that you have documents to back the things that you say. And then do research, research on the investor. Most of the time, entrepreneurs approach private equity funds when they're at an angel stage, wrong focus, because a private equity guy won't give you seed money. Now the various investors. So do some research and know, the investors, know what kind of company investing, the sectors investing, their investment strategy. Most of the time it's on their website, like Chanzo Capital. If you go to our website, you'll see our strategy there. So make sure that you feed that strategy before you approach the investor. Otherwise, most investors will just ignore you or not respond to you. And then approaching investors is important, but it's always good to do it through an introduction. Again, this is where sort of the relationship bit becomes important. So you want to approach me, for example, but you don't, know me, or you don't have access to me. But, you found out in your network that you have a friend who knows me. If that friend introduces you, gives, some weight to that introduction, I'll most likely take it, right? Because I get a lot of inbound, and so do a lot of investors. So most of the time, it's not that investors are difficult, it's just you get a lot of inbound. And so, going through introduction helps. Maybe there's no introduction, maybe an event, like this event, maybe some of you came because you wanted to talk to me. So the event gives you an opportunity to get to meet with me and understand what I look for, and then, that kind of stuff. So it's important to use those channels and other channels to reach investors. And finally, when you, get connected to an investor, it's important for you to, be clear about what you're looking for and your investment process. But I always tell entrepreneurs, be flexible, right? Because, an investor may agree something with you, but, life things happen, things change. For example, one day an entrepreneur, I had a call set up with an entrepreneur, and then, a few minutes before the call, I had a family emergency, so I sent out a message and said, look, can we reschedule? Because I have a family emergency that I need to deal with. And the entrepreneur wasn't, the response wasn't the best, But generally, things happen to people and that kind of stuff. But it's also important you see the investor as somebody who, could have uncertainties the same way that you may have from time to time. So whilst you should be firm and be clear on your process, it's good to be flexible when things don't work. Try to reschedule and try to be accommodative, because it's the same thing with entrepreneurship. Everything in entrepreneurship that don't always work the way you want it to work. Most of you will attest to the fact that the company you're building today, when you thought about it in the beginning, it wasn't the same way you thought about it. But today, you're doing something significantly different because you were flexible. So flexibility is very, very important, even for what you do. So I'll finish with some final don'ts, some things that you shouldn't do, and I say this from our experience at Chanzo that we've learned from a lot of entrepreneurs. It's important not to come across as desperate, but be confident. A lot of entrepreneurs think that when you express desperation, it makes the investor, change their mind or not. It doesn't really do that. What is important for an entrepreneur is to be very confident of what you're building, right? Every investor knows that you need capital to do what you're doing. And every investor knows that if you don't get capital, there's a certain level of limitation that you have. But the importance of your confidence should come from your customers, right? If you've been able to build something that you have 2, 3, 4, 10, 20 customers, that is your confidence position. Because the reality with every business is that you are fundamentally building a business for customers that will use the product or the service you have and pay you for it. So that should be the strong part of your confidence level. Even if you have 10 customers, it's important to be able to say that. Every investor wants to see that you've built something that somebody's using and is paying for it. Because then I know that when I put money into it, I will get my money back or I will get a return, right? So projecting confidence is much more important than projecting desperation. And also don't use unnecessary documents, right? Sometimes entrepreneurs, flood, investors, so much stuff, always make sure you send relevant stuff that the investor asks for, because, a lot of unnecessary stuff, may just, cloud things, and then it's important for you to make sure that you communicate in the right time zones, a lot of the time, entrepreneurs, don't do if you do the research about the investor and all that, where the person lives. So that, maybe you don't want to send a message, your time zone is, it's 12 noon, but maybe the investor is in Alaska. So it's midnight. You don't want to be calling the person in the middle of the night. So these things are simple things, but they make a difference, so just keep them in mind. And also try to be as non-intrusive and non-invasive as possible, because an investor gets a lot of inbound, so try to sort of understand those, boundaries and help, and it helps for the investor to see you differently, because most entrepreneurs, sometimes sort of don't pay attention to that. So if you pay attention to that, it gives you a lot of leverage and latitude with investors. And the last thing I say is to always leave some money on the table. And what I mean by this is, from experience, a lot of the time, when you are negotiating with an investor, right, you need to see the investor relationship as a long-term relationship. It's almost like a marriage, right? An investor would most likely invest in your first round, but you want him to be able to bring his other friends to invest in you. You want him to be able to say good things about the business going forward, because other investors will invest because of the previous investor that you have, right? So always try to make sure that you have good relationship with your investor. You may not agree on everything with investors. You may not agree on all the things, just like life. You don't agree with everything with even your brother, your sister, or if you're married, your spouse, right? But you focus on the things that bring you together. So try as much as possible to do that. And don't try to nibble over the little things, because an investor will bring a lot of leverage to what you're doing and help you build long-term relationships. So I think I've done a bit over that 20 minutes that Sandras gave me, but I hope this is helpful, and I'm happy to take some questions.
Thank you very much, Eric. This is really good. I'll ask some of the questions. Thanks. This is really, really good. Thank you very much. And seeing like in the comments on YouTube and in Zoom and how people are appreciating this. A question from me, like, what are the things that just impress you the most when you meet an entrepreneur? You feel like, oh yeah, I think I should listen more to this entrepreneur.
What impresses me most about an entrepreneur is their value system, right? And you always see that in the way they approach the problem they are solving. And it's also come across in how they build the product and how they deliver the service. And in the long term, that is really what makes a business stand out. And so when I'm talking to an entrepreneur, when I'm doing what I call the execution risk analysis, well, eventually I'm talking to you as an entrepreneur, right? I spend time with my entrepreneurs, and I'm lucky that I get to travel a lot, and that's why we have office on the ground. We spend time with the entrepreneur, because part of it also is that the entrepreneurship journey is not smooth. You're always going to face a lot of problems and challenges. So an entrepreneur's value system comes to play when things don't work out. How does this person deal with challenges? When the customers are screaming, I will get a sense of how you react from your value system, right? So for me, a lot of the due diligence at an early stage is really about getting to know the entrepreneur and how they carry themselves and how they see life in general, right? And that will permeate into the business they build and how that company culture evolves eventually.
Cool. Another question is from Rita Lolly saying that she is worried about giving you a lot of information to investors. And the worry is that the investor will go off and start the business. Do investors want to start businesses? Will investors steal ideas and steal companies?
Well, look, so, I mean, there's some entrepreneurs have had these experiences, where, ideas, but, ideas are a dime and a dozen, and this is very important. Please listen to me. The entrepreneurship game is not about ideas. It's about execution. Any idea you have, probably there are 10 other people that have that idea. The difference is who actually takes a step and execute. Look, companies like Cellulant, Flutterwave, Paystack, Epic Contest, Ampix, Haptel, these ideas are not unique. Everybody will tell you, I had that idea. Anytime a business succeeds, there are probably 20 people who that they say, oh, I had that idea. The difference is who executes. So pay your attention to execution, because if you can execute fast, then you have what they call the first mover advantage. Now, yes, people might have had experiences, with investors, which are unfortunate, and as an investor will offer an apology that, like every other creed, there are always bad nuts, So, but not all investors are like that, So you also have to give people the benefit of the doubt. The fact that you had a bad experience doesn't mean everybody's bad. Generally, I believe there are more good people in the world than there are bad people, and everybody has a tendency to do something that may not augur well for you. But generally, you need to be positive, and you need to always give people the benefit of the doubt, and believe that when you talk to someone, you want to obviously be, conscious of your experience, but also make sure that you can be confident and engaged and get the best out of it. But majority of investors, like entrepreneurs, are great people. They are trustworthy people. They are people that are there to help you. And this is why doing research on them is important. Look, one simple research is, if you want to talk to an investor, look for another entrepreneur that they've invested in and talk to that entrepreneur. It will tell you something. If you had a bad experience with that entrepreneur, maybe they may not be together still, and you tell you something. So do your due diligence also as an entrepreneur on the investor before you approach them. It'll make a bit of a difference.
I like that. And the idea of, like, people are different, and there are good people and bad people, but the people in the world are generally good. Otherwise, the gig economy, things like Airbnb and
Exactly.
Uber wouldn't work, right?
I mean, you jump into an Uber car with somebody you don't know, right? You trust them. It's
Exactly.
trust right there,
You go to a completely
once in a
new
while, an Uber
country.
driver
Yeah.
may be somebody
Yes.
bad, but it doesn't mean that everybody's bad, So.
That's right. And I think there's a question from Christine, but it's been answered, because Christine is talking about the recipe for a business, that somebody will steal that recipe. But I think we've answered already that it's execution. You could have Gordon Ramsay's recipe, but you can't cook food like Gordon Ramsay, right? Let's see, another question.
So I see Ernest has a question about how long it takes for an application to get funded.
Yes.
Ernest, it varies, anything from 3 months to 1 year or more. It depends. But generally, you should give yourself that kind of window, depending on what stage you are, what materials you have, how well you're prepared, how much you are fit with entrepreneurs. I mean, I've met entrepreneurs that I invested the same day. I wrote them a check before we even had an agreement because I knew them before, and we've done the background checks and all that stuff. So it varies, but that will give you a bit of range.
Great. Another question is on execution risk. Could you explain that again? Like, what
So
is the
execution risk is
execution risk?
basically the risk of making what you are saying happen, right?
Mm.
So, there's a probability that you may achieve exactly what you say, but there's also a probability that you may not achieve exactly that, or you may not achieve at all, right? And I think the idea is there's a chasm there. And so I am looking at how plausible that is. By the way, execution risk is not a term that I invented. It's a term that has been there for years that investors use.
Great. Chris Simpson is asking, why do investors, mentors find a problem with signing NDAs?
Correct. Very good question. You see, generally, I talked about ideas, right? Ideas are a dime and a dancer. Now, if I sign an NDA with you, and then tomorrow, for whatever reason, I don't invest in your business. And then tomorrow, somebody comes to me with the same idea, but maybe that person pitched it differently, or that person is a better fit for me based on my criteria. Immediately, you would then say, oh, you cannot invest in that idea because I signed an NDA with you, or you may sue me, right? So generally, this is the reason that investors don't sign any, because we get exposed to so much ideas. And so, it's hard for us to then commit to signing an NDA. I mean, these are very important tracks. And so the way you do it is that when you engage with an investor, so now let me talk about Chanzo. So what we do at Chanzo is that we normally make an upfront declaration, right? So if you are pitching me an idea and I already have somebody like that, I tell you upfront. Or if I invested in a company like that, I tell you upfront that, look, this idea looks like this idea I've invested in, or I'm talking to this entrepreneur. And then I give you the option to decide whether you still want to tell me about the idea or you want to change your mind, right? Because I cannot sign an NDA, but I can do a disclosure. So generally at Chanzo Capital, what we do is we do disclosures to entrepreneurs. And then you can then decide whether you still want to share information with us or you want to recuse yourself.
Brilliant. Thank you. Thank you very much, Eric. What would be some of your final words, words of advice or words of encouragement to all the entrepreneurs who've joined on this call today?
Well, first, I want to congratulate you, Sandras. This is a great event. I want to congratulate you and the entire team, putting this together. To the entrepreneurs, look, entrepreneurship is a marathon, right? It's not a sprint. So when you get into it, it's a long haul and you must be ready for it. And I always tell entrepreneurs, if you don't give up on your idea, you eventually succeed, right? And that's where tenacity becomes the key word that I will leave you with. That keep at it, keep chipping away, you will eventually succeed. But it's important for you to understand that you are not building companies primarily to find investors. You primarily build companies to find customers who use your service and pay you for it. That's your fundamental responsibility. So keep your eye on the customers. Don't give up on the idea and keep doing it, and you eventually win. And if you succeed with customers, investors will call you. Actually, that's a better way to raise money because every investor wants to back an entrepreneur that is succeeding, right? So if you eventually are succeeding with customers using your product, investors will eventually call you because entrepreneurs have the leverage and you need to keep that leverage.
Fantastic. That's like proper mic drop, you know. Really, really good, Eric. Like I love listening to you and I love the work that you've done. Like you are passionate about entrepreneurship, believing in the entrepreneurs in Africa. And this, which I say that why we build Startup Circles, like we want to bridge that gap between investors and entrepreneurs. And what you're doing, showing that commitment to say, hey, here's the answer sheet. Okay, just do this. then you're gonna pass, right?
Yeah, yeah.
Which
And
is
I think
really,
that's what
really
you are
good.
doing with this event, and that's why I'm
Mm,
happy to be part of it, because I think it's good that we're able to get entrepreneurs to understand the things that we look for, and that way, the gap closes up a little bit, and it's easier, and life is better, because eventually we investors don't have a job if the entrepreneurs don't succeed. Yeah, really, the entrepreneurs have the leverage. So I'm always happy to share and help entrepreneurs in that regard.
fantastic. Thank you very much, and thank you very much for joining us today. Wakanda forever. Excellent. Thanks, Eric. And so you can visit Eric's website, which is Chanzo Capital, and or Chanzo Capital, and then you see what they look at, like the answers that I mean to some of your questions, saying what does Chanzo Capital invest in, what do they do, where are they, and Eric explained, saying for every investor that you find, just do a little bit of homework. So it's chanzocapital.com. Just look at that. And when you do your homework and you prepare your pitch, Eric is there. So, again, something that we've done at Startup Circles is to make it easy for you entrepreneurs who are executing, right? Like Eric said, like the ones who are just making things happen, there are investors who are willing to listen to you. And at Startup Circles, we make the introductions easy. So a lot of investors do not take unsolicited pitches because they receive too many of them and they have no time to start vetting each one. So at Startup Circles, we do that vetting. We create that funnel and say, hey, you are in Ghana. Eric is there and is looking for this, but you also need to do your work. So fantastic, fantastic. Thank you very much, Eric.